Today on Daybreak, we are doing something a little different, and I think you're going to enjoy it. I'm reading you one of the most popular series that we've ever published at the Ken by our finance editor Anand Kalyanaraman. It is about your money and it answers a question that almost all of us wrestle with. Where do you put your surplus money when you finally have some? Whether it's a lakh, 10 lakhs, or a full crore. We first ran this back in January, and now the same experts have answered all over again 6 months into a market that's changed on them completely. This one normally sits behind our paywall, but today it is yours. Let's get into it. It's been a forgettable 6 months for many investors since the Ken published its inaugural edition of Where to Invest 1 lakh, 10 lakh, and 1 crore rupees in January. The US Israel war against Iran took a toll on India's already struggling stock market. Then, despite rising inflation and looming interest rate hikes, gold cooled and silver crashed from its highs. Real estate did not offer much to write home about either. So, in the hunt for returns, many investors sought fixed income options. Fixed income yields may be low, the reasoning went, but something better than nothing. Which brings us to this second edition. The Ken posed the same question: where should investors put their surplus, to the same experts from 6 months ago? Only this time, the question to the four Sebi-registered investment advisors and the private wealth manager came with a very different market reality. You could splurge your surplus, whether 1 lakh, 10 lakh, or 1 crore, if you felt so inclined, and that would just be fine. But if you, dear investor, choose to delay gratification, the five experts offer a raft of investment solutions, from holding steady to changing tack to becoming more opportunistic. The solutions range from the simple to the unconventional. The consensus has not flipped from 6 months ago, but the reasons for diversification have grown stronger. There are some don'ts and home truths too. Here, we crystallize their insights to try and answer the big question: how to invest 1 lakh, 10 lakh, and 1 crore rupees. The valuation hawk. Sumit Duseja is cautious about India despite price to earning multiples correcting as earnings growth is not showing strong signs of picking up. The co founder and CEO of global private wealth management company True Mind Capital prefers large cap oriented flexi cap funds, which allow managers to pick good small and mid cap stocks too. He is bearish on US tech stocks but bullish on US value stocks and healthcare, which he advises buying with ETFs or exchange traded funds. Continue to see value in China and the UAE despite geopolitical risks. Prefer diversified Asian ETF, China, Taiwan, Korea, and Singapore, where valuations are more reasonable than the US, says Duseja. He also recommends allocating 15 to 20% at gold at current levels and to silver after a significant correction from current levels. He also advises putting 5% towards copper as a structural deficit in the metal supply is likely to drive up prices. Debt should be a strategic part of the portfolio. Go for liquid debt, which can be moved to equity when valuations are more comfortable. For debt, Doseja prefers arbitrage funds over fixed deposits due to their tax efficiency. Avoid duration plays as inflation and interest rates may rise. Do not go for specialized investment funds or SIFs until they build a more solid track record. To justify allocation to alternative investment funds or AIFs and portfolio management services or PMSs, they must generate significantly higher returns to overcome tax and fee hurdles compared to mutual funds. The SAGA suggests global exposure of 20 to 30% and domestic equity exposure of 30 to 60% depending on risk appetite. If surplus is less, confine investments largely to the domestic market because the Indian mutual funds channel to global investing has shrunk substantially. Shashi Singh, founder of financial planning firm FinMind, says that the specific surplus, whether 1 lakh, 10 lakh, or 1 crore rupees, is secondary to the investor's risk profile and existing asset allocation. Before investing the surplus, ensure you have an emergency fund and adequate life and health insurance. Deploy surplus as per your timelines. If the goal is to earn returns within 3 years, put the money in arbitrage or money market funds. If it is within 5 years, go for corporate bond funds. And if it is between 5 and 10 years, take a hybrid investment of debt and equity. And if it is beyond 10 years, choose equity. Don't try to time the market. Stick to predetermined asset allocations, say 60% equity and 40% debt. Deploy the equity portion over 1 to 6 months and the debt portion at one go. International investing is attractive but currently difficult for Indians looking at domestic mutual funds with exposure to international equity due to SEBI and RBI caps. For smaller amounts, it is not worth investing directly abroad given brokerage, AMC, and currency conversion charges. Those with big surpluses could consider island domiciled ETFs through international brokers to avoid capital gain taxes, dividend tax, and estate tax. Prefer India over the US right now. Valuations are relatively better in India, there is better inflation management, and the country's indices don't have the risky, top heavy nature of the S&P 500 that is dominated by mega cap tech stocks. Be wary of hyped AI and tech stocks. Allocate 5 to 10% to gold as an inflation hedge, but be wary of silver. Singh says buy index funds for large cap and mid cap Indian exposure. Active investing can do better in the small cap space, but do not recommend small caps at this time. Also, stay away from AIFs and PMS due to the lack of transparency, high churn, and high fees. Avoid SIFs for now. The Bet Taker. Dipesh Raghav, the founder of financial planning platform Personal Finance Plan, notes that since January, the focus has shifted from standard domestic allocation to aggressive global diversification to hedge against rupee depreciation and capture the AI wave. He recommends an opportunistic 60% exposure outside pure Indian assets. So 20% in gold, 40% in diversified foreign equities, and 40% in domestic equities. Among domestic equities, large caps currently have better valuations than mid cap and small caps. But since foreign assets provide a safety net, he says investors can afford to take higher risks in domestic mid caps and small cap segments. Choose mutual funds over PMS and AIFs due to tax efficiency and transparency. Passive funds are best for large caps, while active funds may still add value in the mid cap and small cap space. Raghav says the world will never go back to its quiet self. One or the other supply chain will get disrupted, so commodities could be a decent play. Gold has been under pressure due to high interest rates and rotation of gains into tech bets. But gold remains a vital hedge for Indian investors against currency weakness. Uranium and other commodities linked to the AI boom have emerged as tactical options. If the sole aim is higher returns and portfolio essentials are already met, he says, I will not look at fixed income as an opportunistic bet at this point in time. Debt investments lose value to inflation and the rupee weakness. If you have a big surplus and the willingness to take higher risk for higher returns, go for commercial real estate with 7 to 8% annual yields. Bitcoin may be acceptable for aggressive investors provided the bet sizing is small, say 1 to 5% of the portfolio. The strategy champion. Ravi Saraugi, co founder of financial planning firm Samasthiti Advisors, says investing a surplus is no different from managing a core portfolio. It must be mapped to the timeline and priority of financial goals. He says investment principles such as asset allocation do not change every 6 months despite market volatility. Stay focused on long term goals rather than tactical market timing. Use the surplus to fill shortages in your goal buckets. Allocate assets based on whether the goal is mandatory or discretionary. For instance, if money is needed for your child's education, which is a mandatory goal, within 3 years, do not put it in equity but in safe assets like FDs. If the money is needed for, say, travel within 3 years, which is a discretionary goal, it can go into equity. Go for international investing, but in the right way. Do not make predictions about specific country performance or short term commodity movements. Buying single country ETFs like US only or China only does not really provide diversification if their correlation with the Indian market is high. Selecting countries can be as hard as selecting stocks. Instead of country specific ETFs, look at ETFs with exposure to a basket of countries. For instance, there are ETFs that invest in a basket of emerging market countries or a single ETF that invests in non US developed market countries across Europe, Australasia, and the Far East. Also, don't just diversify internationally in equities, but consider international debt, real estate, and commodities as well. Diversification only works if international investing is a significant portion of the portfolio. At least 20% of the portfolio is needed for international exposure to change the risk profile. Since Indian mutual funds are currently restricted from global investing, the liberalized remittance scheme or LRS that allows individuals to remit $250,000 annually remains the primary source to invest abroad. The Wealth Whisperer. Sachin Jain, Executive Vice President at Trigen Wealth, which advises family offices, says that high net worth individuals or HNIs are moving towards private credit or AIF category 2. These funds target 10 to 11% post tax returns, 15 to 16% pre tax, through regular interest payouts from lending to companies. The principal is returned after 4 to 5 years. Those with surplus of 1 crore rupees can consider these. Jen says, with Indian equity not delivering for nearly 2 years, credit is now the flavor of the season. Every large asset management company is launching credit funds. Private credit AIFs have higher risk, Jen says, but they are generally secured against assets and defaults are rare. Those with less than 1 crore rupees can consider debt PMS, a minimum investment of 50 lakh rupees with 8 to 10 non convertible debentures or NCDs in the basket targeting 9 to 10% returns. Investors with lower surplus can seek advice and buy secured NCDs of good companies. Jain is bullish on Indian equities from a long term perspective. The current Nifty level of around 24,000 is a good opportunity to invest and to continue with SIPs. For HNIs with higher risk appetite and a longer term horizon who are seeking equity exposure, private equity AIFs that invest in unlisted stocks offer a decent option. The targeted returns of over 20% come with higher risk. Alternatively, hybrid AIFs that give exposure to private credit, private equity, and listed stocks can be considered. The risk is relatively lower, but so are the returns. Jen recommends a staggered approach of 6 to 7 months in equity to avoid geopolitical volatility due to the Trump factor. AI and tech stocks in the US are in a bubble territory, so go for the relatively undervalued Chinese and South Korean markets over the US. Allocate 5 to 10% to gold as an inflation hedge. The euphoria around silver far exceeded its use cases, so don't buy. For HNIs seeking real estate exposure, real estate debt AIFs with targeted pre tax returns in the range of 16 to 17% are an option. Avoid real estate equity AIFs for now, as expected oversupply can hurt price appreciation. AIFs make sense only if they can give far higher returns, 7 to 8% more than mutual funds to compensate for the higher risks, tax drawbacks, and long lock ins. In a nutshell, most financial planners agree on the fundamentals of investing your surplus. Cover your bases, keep it simple, and diversify across asset classes beyond Indian shores too, if feasible. Assuming the basics, emergency funds, insurance, and regular investing are in place, we use the advice from the experts to devise a framework for investing the surplus for 5 to 10 years. So, if you have a surplus of 1 lakh rupees, Indian mutual funds are the ideal option. Foreign equity exposure can wait, as it may not always be possible or practical for investors with a small surplus to venture overseas. No point adding complexity and costs to small surplus. But if you have 10 lakh rupees to spare, global diversification begins to make a lot more sense. Riskier, even exotic bets can enter the fray now. And it is a completely different conversation if it is 1 crore rupees. A higher surplus and an arguably higher risk appetite gives you many more choices, but there are caveats, of course. The expected higher returns in private debt, private equity, and the like come with higher risks and costs. But the rich can keep it simple too with tax efficient mutual funds. That said, there is no one size fits all. Varied situations will need varied solutions, and the asset class comes with its own idiosyncrasies and challenges. For instance, it may be advisable to stagger a relatively high surplus deployment in equity over a few months to tide over volatility, while debt can be brought at one go. Scale matters too. The higher the surplus, higher the risk appetite and more the choices. So AIFs, for example, are an option for only those with a surplus of at least 1 crore rupees. 6 months ago, investors and experts were mostly debating opportunities in India. Today, they are talking more about bets that don't quite depend on the domestic market and on bets beyond AI and tech. That perhaps is the biggest change since January.
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings, and a full subscription offers daily, long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the website. Today's episode was hosted and produced by my colleague Snigdha Sharma and edited by Rajiv CN.